Hello and welcome to Options Guide TV. My name is Brian Overby. I'm the author of the Options Playbook, and I'll be your host here for about the next 25 minutes here on Options Guide TV. So I'm going to start out by looking at our VIX position. We've done this twice now. At the end of August, we looked at getting long the VIX using a modified butterfly, going into September, and then on the 30th of September, we decided we're going to do it in October, all based off of the seasonality. I know there's never a rhyme or reason why September and October have a tendency to get more volatility than the rest of the calendar months, but it does happen. It's that simple. So we're got the VIX at 1927. When we placed this trade, the VIX was trading down around 15. I actually don't have the actual number right here, but here's the trade that we put on. It was between 15 and 16, somewhere in that range. And right now, if we look at the futures contract, the actual VIX option contracts that we're using were the October 16th. They got 12 days remaining, so there's still going to be a little bit of time premium in our option contracts. We'd like it to kind of wither away. In other words, we would like it to get to expiration sooner than later, because right now, if we look at the VIX index, we actually have it trading at 1925. And if we look at this expiration and we look at the futures contracts, we see that at 19, the VIX on the call side of thing is $2, and on the put side, it's 69 cents. So it's a little higher than that. So if we just look at the combo right here, so the VIX is somewhere. This is 172 on the ask and then 194 on the ask on the 21. So we're between 20 and 21 on the futures contract. And remember, that's what drives the VIX. If that concept was foreign to you, then first of all, you haven't been following Options Guide TV as much as you should have. So shame on you. And next off, you can read about the VIX and all the little nuances in my Twitter handle on x.com. It's at Brian Overby, at my name. There, if you scroll down in there, there's an article about decoding the VIX. All right, so let's see where it's at. Let's go and put this trade in October 16th. We are buying. When we initially did the trade, we bought the 18, sold the 23, and bought the 26. So we're going to buy the 18, we're going to sell the 23, and then we're going to buy the 26. Note that we are 5 points away from 18 to 23, and from 23 to 26, we are 3 points away. So that is how we modified the butterfly. If this was 5 points from 23 to 28, that would be a standard butterfly. But because we stopped short and we did that, that changes our profit and loss graph quite a bit. So we're going to send this to the what if calculator, pull it down, and we'll talk about this a little bit here shortly. But let's go back to here. Okay, so we got this trade on. Midpoint is 147 on that trade. That's $147. We first put the trade on for 75 cents. We can now get the trade off for 147. So we doubled on the trade, and that was just in a few days. So if you wanted to take the trade off here, I don't have a problem with it. The VIX is a very scary index in that there's 1 second it's going higher and the next second it plummets. So if it's always good to get risk off the table. If I had a 5 lot, I would definitely be selling 3 of them. If I'm just doing a 1 lot, well, maybe I stick around a little bit longer. I kind of feel like this volatility is going to hang a little bit longer, but that's just a feeling. There's really, look at charts and stuff like that, but in the VIX, it doesn't necessarily matter like it can in other underlying stocks because it's volatility. It's not price. It's all about the volatility of the S&P 500 index options. All right. So I wanted to go through one little scenario here and run over to the what if calculator. And I put 2 of these butterflies in here. Okay. So this is our current butterfly. And by modifying it, this is what makes it fun. And I do mean fun. I think of this as a fun trade, and the VIX index is one of my favorite indexes to do this modification. The VIX started somewhere around here, down in this range when we first put on our trade. We had 75-cent risk. So now it's switched. It's at 147. So this isn't showing exactly the way the trade we put on, because it's as of today as opposed to when we put it on September 30th. Market goes up, lands here. That would be a home run. Right now, this is the green line showing you how the VIX is working relative to this price. Now, right here, the maximum upside would be $5, the difference between 23 and 18. And from there on up, if we run all the way up to our high strike and beyond, guess what? We still make money on this trade. We're going to make more than they're showing here, but the difference between this spread, which is $3, and the difference between that spread, which is $5, is $2. So the butterfly is going to be worth $2 at expiration. We paid 75 cents for it. $1.25 is what's left. So you have that potential to make $1.25 if the VIX skyrocketed like it did in August and run all the way up to 40, 50 level and then pull back down and hang around 30, you're still good on this trade. So that's why I like the modification. You got to pay a little bit more up front, but you're talking about nickels and dimes up front to be able to have the, I guess, less concern about the VIX just skyrocketing. Now, on the downside, if it goes down, it's not going below 10. It's just the way the VIX works. If it's on the upside, we want it to land somewhere between 18 and 26, somewhere in that range. And we're going to be good on this trade if we rode it all the way to expiration. But usually with butterflies, my rule is that if it doubles, you get out. Don't try to hit the home run. If you have more than one contract, you can adjust that. I don't mind you have a 10 lot, like sell 7 of them, let 3 ride. Because every day that goes by in the VIX is huge. Right now we have 12 trading days until we get to the normal VIX expiration. It's on a Wednesday, and we have 12 days. So if you get down to 10 days left, that is a lot of time decay. And if you're within the width of your strikes, within the wings of your butterfly, each day that goes by is going to be a huge amount of time decay. As a matter of fact, it's looking like $4 it's going to be a little bit screwed up because of the futures contracts, but every day that goes by, you're going to gain $4, and then that's going to go up precipitously as we get into the last 7 days to expiration. That's where theta decay is at. So if you have any questions about this VIX trade, like I said, this is one of my favorite trades, and then my favorite underlying to do it in is the actual VIX. But you can put it in the chat box. If you are in the YouTube platform and you're logged in on the Tradier YouTube, you can ask questions via the chat box. And also, if you're inside the Tradier hub at hub.tradier.com, if you don't have a profile, you want to set one up. But if you log into your profile, which is free, everything's free inside there, you get access to all the great speakers inside the Tradier hub, and you have that ability to ask questions through the hub. Okay, 147. Let's leave that trade there. Now, what I'm going to do is, recently I've noticed this kind of popped up on my charting platform. And I froze a little bit here. Well, I'll highlight it this way. Okay, now I move it. No. If I look over here and you look at Apple, eventually I'll zoom this in. But if I look at Apple, you see right at, okay, now I can zoom it in. Right here is a very interesting resistance level. If we ever pop out, these are the highs in Apple all the way back here, but we've really had a lot of chop. We're still got our ducks in a row. We got the 200-day above, and then the 50-day is above that, and then we're just there with the 20-day moving average. But we're coming down. It looks like we're kind of going to bump on this 50-day a little bit, see if that's provided some support. It's just dancing around it. Oh, right here, it definitely touched it 3 times before it decided to take off. And then it came on up. Okay, so in this range, we're going to sell something right here. We're going to do a shorter term trade. So now here's my thought is, and I've said this over and over again on Options Guy TV, that even though we had the Fed come out and kind of surprise the market, even though it wasn't a huge surprise because the Fed funds future said there was a 50-50 chance of this happening, but they lowered the Fed funds rate by 50 basis points. That gave the markets a reason to go to a new high, even though they were schizophrenic in the way that they approached it. In that at first they're like, oh my gosh, what's going on with the economy? How come the Fed did it 50 basis points? The economy must be really bad. And then they all of a sudden stopped and said, oh, but if they went 50 basis points, they must not be worried about inflation. And so we had some jobs numbers out this week, and they were, they were higher than anticipated. And that's what we really want to see. We want to see inflation coming down. We want to bring interest rates back to a more quote unquote normal rate. If anything, dealing with our national debt, that's a big deal. I just wish somebody would start worrying about the national debt, but that's for a different day. But with that all said, we bumped up against this resistance line. I want to stay bearish in October until we get past this election date. I think that uncertainty is going to make it hard for the market to continue on up. Even though everything has been solid across the board, as far as economy, jobs are doing okay, interest rates are starting to come down. So I'm going to sell a credit spread in Apple based off of this resistance. And if we ever did break through, so this is 233 is where that level is at. 235 is what we're going to sell. And if we ever did break through and hit that 235, as a matter of fact, I'm ready to flip that script, because then you're looking right here for that new high on Apple. All right. So I don't mind if it actually happened, going and closing out our short call spread and buying a long call. That would be the way that I would approach this. But I really like where the market is at relative to the 235 strike. They have earnings at the end. I haven't seen the date locked in yet, but they're anticipating somewhere around October 31st. So we're going to avoid October 31st, and we're going to use the 25th expiration, because I don't want to be in this trade going into earnings, and we don't want implied volatility going up going into earnings. So that's where we're at. Shoot, I'm back. Am I back?
You're back, but your background is different. I can't hear you. Right. You're muted yourself.
Yeah. Okay, there we go. Are we there?
Now I can see your green background.
Yeah. Okay. And then for some reason it came unplugged.
Yeah.
Okay. And everybody's still here, hanging with me. Come on. Here we go. Let's ride with this.
Okay. Yeah.
I got to share my screen.
Yeah. No, you're sharing it.
Okay.
Okay. That's it.
There we go. No, bring it back out. Bring it back out. Technical difficulties. I apologize. But what we're going to sell that 35 strike. Okay, there we go. Let's go. We're going to sell that in Apple. We are going to sell the 35 strike, and we're going to do the October 25th expiration. And here's our 35. We're right within a 1 standard deviation move. The delta is right around 20. We're only a couple of points away, but right around 33 is where that support level is at. I'm not going to adjust the trade unless it got up towards that 235 level. But if I sell this contract and then I go up 5 points and I buy this contract, we're looking at a net credit of 74 cents on the trade with 21 days to expiration. And if I send this to the what if meant calculator, you see that here's where the current market is at. Here's where our risk comes in. We're risking $4.25 to try to make 75 cents on this trade. If we can buy this back for 20 cents, we're going to think about it. Ideally, we'd like to buy it back for around 10 cents. We're bringing in a little bit smaller credit. It's a little bit shorter sweet. We're avoiding earnings. And you can see the difference in implied volatility between the November 1st option, implied vol is at 26%, and the November 25th option where the implied volatility is at 22%. So that's going to be our paper trade for the week. The VIX trade is still looking real strong. And the markets, I just expect it to be more bullish than bearish, but definitely nervous. Mondays in October are always scary. That's whenever they've had real big downturns in the marketplace. So we have a few days for our VIX trade to live. You could close it out today because we had a doubler on it. And if I had a larger position, I would close out at least half of it. But I'm willing to stay the course. We will be back. We'll be back on Monday for the next edition of Options Guy TV. And I don't mind staying in this trade until that Monday. See what happens over the weekend. Thanks for coming. And we'll see you on Monday at 11 a.m. for the next edition of Options Guy TV.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.